Welcome back to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. And joining me live at MarketSite is Joe Halpern. He's a portfolio manager over at Catalyst Funds. And today we are going to take a look at low volatility fund strategies. Joe, thank you very much, and welcome back to MarketSite. Before we get into the funds that are launched over at Catalyst, let's talk about your outlook for 2018. Will we see a repeat of 2017?
Great question. So I have a couple interesting facts for 2017. Volatility for the year, actual volatility was under 7%. And the amount of days where you had an up or down 1% move was less than 10. So to put that into perspective, it's been over 50 years. I had to go back to 1965 to find a year that was similar to that in terms of volatility, in terms of movement, right? And to put it even more in perspective, in a typical year, you have over 50 days where the market moves more than 1% a year. Right. So really easy prediction for me to make on the show would be that we will see more volatility in 2018, right? Volatility just has to move up from these levels. They were sub 7%. People follow the VIX more than ever nowadays. VIX has hit new lows from the time they started. If you went back to the 1960s, I'm sure we would have had these lows back then too. I think we'll see more volatility. I think, I can't believe the market can stay so consistent and so perfect in its progression up.
Right. Well, a lot of questions that we get are, well, what do you do in a low volatility environment? How do you make money in a low vol environment? How do you trade this? And so let's hear about the Catalyst Succeed defined risk and shield funds, because that's what these are designed to do.
That's correct. These are both equity hedged products, right? So both products look to really provide a hedge to the market. And I'll explain both of them. So the Catalyst Succeed Defined Shield Fund is really a tail risk product. It looks to protect you when the market falls further than 10-15% on an annual basis, while providing participation up to a cap of around 15%. So a consumer would take first losses down to about 12.5% on an annual basis, but they'd also capture gains, up to 15. And then if you have a 2008 scenario where the market is down 30-40%, and we haven't seen that in a while, you feel pretty safe and pretty safe, I guess, right? And so ultimately the way we're doing that is buying insurance consistently on the market. And the defined risk product looks to provide a buffer in the market. So again, looking to provide an equity hedged exposure. It looks to protect you on the first 10% down, right? So in the beginning of 2016, for instance, was the last time we had a real move down in the market, right? The market moved down about 10-15% relatively quickly. And that was on a year-over-year basis and on a quarterly basis. And that's where a defined risk kind of product could really help you, right? It looks to protect on that first 10%, but you take risk thereafter, and it participates up to a cap. And so it's really interesting. When looking at context at this market over the last year and a half, we've been straight up. There's been no bumps in the road, and that's very unusual. If you look at the last 25-year period of the S&P, year over year, if you look every month, year over year, fully 25% of those periods, you had down markets. And most of those down markets, so 25% of that population, right? Most of those down markets were between 0 and 20%. So having a 10% buffer will fully or materially protect you on most of those downfall, those declines in the market, while the shield product will protect you from the real big ones, right? The 2008s, the 2001s, et cetera.
What kind of indexes do these funds track?
Right, so they're both Nasdaq-based indices. We partnered with Nasdaq a few years ago, and so they both launched, I want to say in 2014, and both of them are looking to use options to provide that consistent and defined downside level of protection, right, and providing those exposures. And what's really interesting about these products, when you look at equity hedge, it's always difficult to really define what is that exposure. And these are really tools to allow an advisor or an investor to really match the exposure they'd like to take in the marketplace, right? And a lot of times it's very hard to understand, okay, what will this product do for me? What will happen in these scenarios? And what we've done is really provided a little bit more definition. And really the first time these sort of products are in a mutual fund construct, we really took it from that institutional world, from what the banks do and what the insurance companies do, and brought this to the market. So we're very excited, and I know Catalyst is very excited to get these products out there.
So I would imagine that registered investment advisors are really, they like these kinds of products for that reason alone.
Yes. So these products fit into a portion of the portfolio, and I'll give a couple of examples.
Yeah.
If you think of going into retirement, so I'll call it the 50 to 70 age group. Conservative group, worked all their lives, have nice savings, and going into retirement, and they're about to start spending it down. And that's where you're at most risk, right? We've seen target dated funds over history. We've seen long short. We've seen a lot of different products to try to help them. But ultimately, they cannot withstand a 2008 event. They can't withstand having their portfolios cut potentially in half in a very short period of time. So right there, that tremendous client base, they have to look around and look and say, what can I purchase out there to still get exposures to the markets, but be safe, right? Put some sort of limit to my losses. And so it's really perfect. Both products are really perfect for that based on what that exposure is that is needed by that end investor. So advisors have really been interested in it. And another element that has interested in advisors is that historically you can only get these sort of products from the banks, and there's some issues with that. There's liquidity issues with that. There's some issues of implementation within model portfolios from using, let's say, a structured note instead to try to get that definition, or an annuity instead to try to get that definition. And by putting it in a mutual fund construct, we're able to provide a lot more liquidity, right? You have daily liquidity at a NAV, at a net asset value, so they're getting the full value back. And then the easy implementation within a model portfolio, which is really important nowadays with where the RIA market's going.
Yep, and I think you're going to see an increase in that as well.
I think so.
All right, well, thank you very much for joining us at MarketSite. And RIAs and traders, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.